You've been lied to.
Oh my, that's an uncomfortable topic.
The S&P 500 actual average return is not 10 or 12% like they've claimed.
You lied to me. You lied to me.
I'm a former financial advisor who used to parrot this same lie to my clients for years. And so in this video, I'm gonna show you the real rate of return of the stock market and why I hate investing in the stock market.
I hate it.
Okay, so let me just start off by saying this. Again, I was a financial advisor. I taught this for years. I was also a stock trader. So someone who loved the stock market, invested in the stock market, and taught others how to do the same thing. However, over the years, I've realized more and more the results just aren't there. And so let me talk about this concept of average return versus real return. So say, for example, you have $100,000 in an account. Now, what if the market drops by 50%? So you lose 50%, right? What are you left with? You're left with now $50,000. Now let's just say that the next year, the market comes back, it comes roaring back, and you make 100% rate of return. So you double your money. So now you have a positive 100% return. Now you're at $100,000 again. The question is, what's your actual rate of return? Zero, right? But what's the average rate of return on this? Well, let's do the math. And I'm going to take you back to grade school a little bit here. You might hate me for it, but you probably need the refresher anyways, right? If you remember averages, you have 100 minus 50, or minus 50 plus 100 leaves you with 50. Now, you got to divide that by the 2 years that this is in, divided by 2 years. That equals a 25% average rate of return. Which one do you think financial advisors and any financial institution will want to show you? Will they want to show you the real rate of return of the big fat 0%, or will they want to show you the 25% average? Which one do you think sells better? 25% all day long. Now, this blew my mind because as a financial advisor, I didn't understand this until about 3 years in, a guy came and taught and used the same example. Just so you know, we all got it wrong because when he asked us, he says, hey, if you have 100,000, you lose 50%, you're down at 50,000. He asked us, what rate of return do you need to get back to breaking even? And all of us brilliant financial advisors said, 50%. He said, no, because 50% of 50,000 is only 25,000 bucks. You'd only get to 75,000. You need 100% to break even. And technically, you got costs coming out, so maybe you're really only left with like maybe 98,000 if you're lucky. But still, they'll tout 25% average rates of return. And I remember this bugged me, and I cornered the guy in the parking lot. I said, well, why shouldn't we be telling people not to put money in the stock market? He said, I can already tell by looking at you, you're in your, late 20s? I was like, yeah. He's like, you're young, you can take the risk. People should be in the stock market long term because you'll make more money long term. But, this is just for the people that are afraid of the stock market now. And I realized something. At that time, guys, I realized I was a salesman in a suit. He was just telling me to do this, say, hey, here's another product that won't lose money. We're just offering this to people that are scared of the stock market. So then we have something to sell everybody, right? No matter what your risk levels are, right? But the problem is, we actually did the numbers from the 1995 to 2005, we would have all had more money had we not lost money in the stock market. Even though the 90s was huge and then it crashed in Y2K and was coming back again, still we would have all had more money making just solid, consistent returns. So this is a big reason why I don't like the stock market. Not to mention, I have zero control. Even as a stock trader where I had more control than throwing away mutual funds. By the way, mutual funds, most of them never even get the S&P 500 returns. But in the stocks, even then, you may or may not make money. In fact, out of the people I coached, even though I would teach them the most, I wouldn't say guaranteed strategy, but the safest strategy to ensure that they don't lose a lot of money, still, I would say only a handful of them could keep making consistent returns without needing somebody to hold their hand. That's a problem, guys. Most people aren't making that kind of money in the stock market. By the way, if you have a 401k, some of those target date retirement funds, guess what they really are about averaging? After fees and everything, closer to about 5 to 6%. Okay? Now, I can already hear it. There's somebody on there commenting right now. He's already got the little troll comment going saying, but Chris, the S&P 500 has been proven to do that much. And especially when you reinvest dividends, you'll have 10 or 12% returns. Let's talk about that. What's the average actual return of the S&P 500 over the last 30 years? Now, depending on when you're watching this video, going from the spring of 1994 till the spring of 2024, the average return of the stock market is 8.1%. That's the S&P 500. 8.1, not 10, not 12. Now, someone make the argument, they're like, yeah, but you reinvest dividends, if you even understand what they're meaning. Yes, they are, but guess what? The S&P's dividends aren't that awesome. At best, it might get you, even at this point, to about 9.7%. Still not 10, and definitely not 12 like most claim to be in the stock market. It's not even close. It's not over 10 at all. And many people will say, oh, it's 10.8%. No, it's not. I've run the numbers, and even with dividends reinvested, it's still not that much. So here's the problem, guys. This is also pretty high. And depending on which 30-year period you're looking at, 1994 was kind of at the bottom of a recession, right? So it was at a bottom going to the all-time high of the stock market here in early 2024. Well, of course it looks awesome. But I've had other times around this number where it's been less than 7% on this side. So even if you have an extra 1.6%, you're still maybe hitting 8.5%. That's not 10. And that makes a big difference, guys. A huge difference. Massively. Because you got guys like Dave Ramsey out there telling you it's 12%. And you're going to make 12%. Do you know that more than 90% of mutual funds don't even earn the same as the S&P 500 right here? They don't even earn this high. They do less. Just like I said here, your Fidelity 401k funds do worse. And you think you're going to be getting these higher returns? This is why I hate the stock market. It's high risk, mediocre returns. Where I could do something like real estate investing, I can make easily 10, 12% a year, sometimes higher on my money, and it's less risky. I have a real asset backing up. Does that mean it's guaranteed? Heck no. Nothing is. But I have a lot more certainty there, and this is also why you see more millionaires being real estate investors than people playing with their money in the stock market. That is why. All right, so these returns aren't great, but again, like I said, you can get better returns in other places. But how would it be if you can get your money to pay you in 2 different places at once? Check out this next video about how you can do that very thing.